Hi, I'm David Lankar from Ocean 6 Wealth Advisor, and today we're going to explore the taxation of capital gains, interest income, and dividends in Canada for personal accounts. Understanding how different types of income are taxed is crucial for individuals looking to maximize their earnings and manage their tax obligations effectively. So let's dive into the tax treatment of these three key sources of income. Let's start with capital gains. In Canada, capital gains arise when you sell or dispose of a certain type of property, such as stocks, real estate, or investments. The tax treatment of capital gains is unique and offers potential advantages. Generally, only 50% of capital gains are subject to taxation. This means that if you realize a capital gains of $10,000, only $5,000 will be included in your taxable income. The tax rate applied to the taxable portion of the capital gain depends on your marginal tax bracket. It is important to note that capital losses can be used to offset capital gains. If you incur a loss from the sale of a capital property, you can use it to reduce or eliminate the taxable portion of your capital gain in the same year or carry it forward to offset future capital gains. Now let's move on to interest income. Interest income is earned from various sources, such as savings accounts, GICs, bonds, or loans. This type of income is generally taxed differently than capital gains. Interest income is considered part of your regular income and is subject to your marginal tax rate, the full amount. This means that more interest income you earn, the higher your tax liability may be. Lastly, let's explore the taxation of dividends. Dividends are payments made to shareholders by corporations out of their after-tax profits. The tax treatment of dividends varies depending on whether they're eligible dividends or non-eligible dividends. Eligible dividends are paid by Canadian corporations that have already paid corporate taxes. They receive more favorable tax treatment. Eligible dividends are grossed up by a specific factor, meaning they are subject to a higher tax rate. However, individuals also receive a dividend tax credit, which helps reduce the overall tax liability. On the other hand, non-eligible dividends are paid by Canadian corporations that have not paid corporate taxes at the full corporate rate. Non-eligible dividends are not grossed up, but are subject to a higher tax rate than eligible dividends. However, like eligible dividends, individuals receive a dividend tax credit. To summarize, capital gains are subject to a unique tax treatment, with only 50% of the gains included in taxable income. Interest income is treated as regular income and is taxed at your marginal tax rate. Dividends can be eligible or non-eligible, with eligible dividends receiving a more favorable tax rate. Thank you for watching, and click on the link below if you'd like to chat more. Thanks.